Well, participants are halfway through a bumper fortnight of event risk for financial markets to deal with last week having seen the UK budget been digested rather poorly by the gilt market, while a soft US labour market report was largely shrugged off, given the figures being considerably skewed by weather and strikes. Looking ahead, the US presidential election now looms large on the horizon, but it's a busy week ahead besides that as well, with 5 G10 central bank decisions and a busy data docket in the mix too. Plenty for us to discuss on the trade-off this week. Without further ado, let's crack on with the show. So lots once again for us to get our teeth into this week. Joining me as always to try and make sense of things is my good friend Ryan Littlestone from Forex Relied and Forex Analytics. Ryan, it was a very busy week for the markets last week. Obviously the budget here in the UK, the soft payrolls print that we had on Friday, earnings from 5 of the magnificent 7 last week as well. And at the end of all of that, I was hoping on Saturday lunchtime to sit down with a beer, put my feet up and relax in front of the football. But well, that didn't really happen, did it?
No, it's another week I'm not talking about football. And yeah, yes, it was a busy week. Yeah, exactly. So pass on that. Yeah, it was a busy week, and it's going to continue this week. And what a week it is! Like you say, you've got the elections, 5 central banks, and everything else to go along with it.
Indeed, I was hoping you might speak for a bit longer there, as you can tell. But there is plenty to discuss, so let's get on with that in Topical Thunder.
And I'll keep talking.
I'm not sure you want to go down that route, mate. There could be all sorts of hand signals coming your way. Oh dear, 2 minutes in, it's already descended into chaos. Anyway, let's try and steer ourselves onto safer ground by talking about the US election. What could possibly go wrong? I've been loath to talk about it all year, but given that it's this week, I suppose we best. It is, of course, presidential election week, with the US heading to the polls on Tuesday, and the opinion polling in advance of that election points to things really being on a knife edge, to be completely honest with you. Looking at the poll of polls, which averages results nationwide from all the pollsters, the Real Clear Politics version of that has Trump 0.1 percentage points ahead, which is, of course, well within the margin of error and basically a dead heat with Vice President Harris. Of course, given the way that the electoral system works in the United States, it's not about the popular vote, it's about the electoral college vote. And given the number of safe Democrat and safe Republican states within the country, it's really all going to come down to 7 swing states. And the polls in those states point to every one of those 7 races being well within the margin of error. And the latest New York Times polls, which are sort of held up as the gold standard, actually have the race as a tie in the key Rust Belt states of Pennsylvania and Michigan. In terms of timings, polls will begin to close from around 7 o'clock in the evening Eastern time on Tuesday, which is around midnight UK time. And of course, from then onwards, news media, both TV networks and the Associated Press, will call results on a state-by-state basis throughout the evening. Now, in 2016, we knew the result around about 2 o'clock in the morning on the east coast of the United States and around about 7 o'clock in the morning here in the UK. In 2020, of course, things were a little bit different. We had a lot more absentee voting, a lot more mail-in ballots due to the pandemic. We didn't actually know the result until Saturday. Indications are we'll probably land somewhere between the 2 timings this time around. Now, I think for financial markets, the initial concern is one of when we know the result. And I would actually go as far as saying when we know the result is perhaps more important than who actually wins the election, particularly given that a longer, more drawn out process brings more uncertainty. It means the result is perhaps more likely to be challenged and is likely to act as a bit of pressure on risk sentiment, depending on how prolonged things become. In terms of the result, and once it's known, I think the consensus very much favours a Trump victory, seeing knee-jerk dollar strength, particularly against those currencies where tariffs are likely to be imposed, such as the CNH, the Mexican peso, and of course the euro, while a Harris win would probably favour a knee-jerk bout of dollar weakness. The outlook for equities, though, I think it's still tough to argue for a longer run bearish scenario under either candidate. Actually, there's very little correlation between the occupant of the White House and longer run equity market returns. But of course, it's important to watch Congress too. It's likely that the Democrats will flip control of the House. It's equally likely that the Republicans will flip control of the Senate. And what that means is you could end up with a scenario where we have a divided government, and that could see whoever is president have some degree of problem passing their legislative agenda. But, and I know you're going to touch on this in a second, Ryan, for a trading perspective, it's always pivotal, but I think perhaps more so this week than any other. Risk management is absolutely key over the next 24, 36, 48 hours until this cloud of political uncertainty lifts.
Yeah, I mean, I remember the times when you got an election and the next day you knew who had won and what had happened.
Nice, wasn't it?
Yeah, it's nice, like the good old days, as we like to say when you get this old. But yeah, it's becoming more like a game show, really. These things, and it's not fun at all if you're trying to trade it. And it's very dangerous, of course. So you have to be really careful. I can only repeat that through the show. You just have to be careful with this one because we don't know if we're going to get a clear outright, when we're going to get a clear outright, and how long it's going to take to get that outright. So yeah, it has all the makings of a big old mess, and that's going to be tough for us trading it.
It is indeed. And yes, if you are trading it, then be very, very careful. And of course, just to give a little bit of self-promotion, Pepperstone Research Desk will be open, of course, throughout the night. So anything we can do to help, then do reach out. And Ryan, maybe even you're staying up for this one, are you? I know you've got a little bit of a loathe to get up early these days.
No, I'm not getting up. We had enough with our election. I'm gonna wake up at my normal time, flick on my phone, and see what's happened. And if I'm in any positions, if they've gone wrong, I'm going to stay in bed.
Oh well, there we go. That's perhaps the other way of dealing with things. Well, anyway, Kyriakos has moved our graphics on, so I think that's a subtle hint selling into telling us to hurry up.
Yeah, better get on with it, sir. No problem. Yeah, we're going to. Going to look at what's going on in the central bank world, because as Michael mentioned, we do have 5 central banks reporting as well. So if one can tear oneself away from the elections to look at those, then we'll do so. Firstly, obviously, the RBA meeting, which will be by the time you've watched this video or by the time this is out, so that'll be done and dusted. So I won't touch on that too much. Safe to say, I have been looking for perhaps a bit of a shift further away from their hawkish sentiment. So we'll see if that happens. It's really all happening, though, on Thursday. We get a Scandi double from the Riksbank and Norges Bank. Riksbank Governor Janssen said in early October that 225 cuts were possible in November and December. And that was the main scenario for them. But he said that a 50 pip cut is possible and would be consistent with a gradual approach. Then last week, he actually said that inflation risks have diminished enough that they can proceed a little more decisively on easing, hence why the RICS is expected to go a 50 pip cut on Thursday, taking their rate down to 2.75%. Norges Bank, they are set to remain unchanged at 4.5%, as the bank have indicated. They're due to remain unchanged for the rest of the year and then perhaps begin cutting in 2025. So if they do remain unchanged at this meeting, just keep heads up if you're trading or not, in case they do decide they want to slip in a little cut before the year end. Lastly, we have the BOE. That's something Michael's going to talk about, so I'm not going to step on his toes for that one. Yeah, exactly. I'll get told off again. So lastly, we do have the Fed. Now, this would have been an interesting meeting in the midst of the election had the Fed not already started cutting rates. But since then, Powell has obviously cut the 50 and made it abundantly clear that they're going to cut twice more for a total of 50 basis points at their last two meetings, and that 25 pip cuts would be likely. So unless they've really been shaken by Friday's jobs report just gone, they should go 25 at this meeting. But comments on how they see December and next year will need watching. Overall, I think this Fed meeting is a bit of a can kick until the election is fully passed, but we should expect Powell to get lots of questions on the election about it, which, of course, he'll do his best to brush aside, shall we say.
Yes, indeed. And I think the Fed absolutely have to cut by 25 basis points this week, given how well telegraphed that move has been, and also given the uncertainty that markets will already be dealing with. The absolute last thing that the FOMC are going to want to do is add to that. So copy and paste the September statement, but scribble out the bit where it said 50 and write in 25 instead. I think that's about as much as they're going to be doing. I think those Scandinavian central bank decisions are probably the most interesting from the perspective of trading opportunities. You know, the Riksbank, they could do 25, they could do 50. Are the Norges Bank going to be the latest to turn a little bit more dovish, a little bit more cautious? But let's be honest, in the grand scheme of things, it's all going to be massively overshadowed, you would imagine, even if we know the election result by then, which we obviously hope that we will. You've become a mime artist, I'm afraid.
Oh, sorry, hit my button. Yeah, I'm going to talk about it a little bit later on, but yeah, this is one of those moments where what other central banks do may not be important right now, but to match the moves off that we get over the election with what other countries and other central banks are doing is going to be important moving forward if we get a bit of a shift away from the fundamentals of those countries.
Yes, absolutely. Right, moving on. Go and make yourself a cup of tea, get some biscuits, sit yourself down, put your feet up. This is something that we have to discuss, which is, of course, what's going on here in the UK at the moment. We had the budget last week. Chancellor Reeves standing up in the Commons on Wednesday to deliver her first budget, the first Labour budget since 2010, in fact. And well, it was a bit of a shambles, let's be honest. I mean, I guess the summary of the budget is that we have very high spending, very high tax, very high inflation, very high borrowing, and not really much economic growth to show for it. So to put some numbers on all of that, the budget raises taxes by around £40 billion per year. By the way, these aren't my numbers, these are the OBR's numbers, and raises government spending by around £70 billion per year, which, work that out, 70 minus 40, that's a 30 billion shortfall, and it leads to about 140 billion pounds worth of additional borrowing over the remainder of this parliament, which takes us to the middle of 2029. Now, of course, myself, most market participants, certainly those in the gilt market, look at that and go, okay, that's fine, but what do we get for it? Well, according to the OBR, what we get is inflation that will be north of 2% until 2029, and we get economic growth of a rate of below 2% for the next 5 years. Now, that is not to say, I must stress, that the investment plans that the government have outlined are not going to boost GDP growth, because according to the OBR, they are. They're going to boost GDP growth by 1.4%. by 2074, by which point I don't think I'm going to be doing this show anymore. And I don't think perhaps we won't even be around in 50 years' time, depending on what happens. The other issue is that the measures leave very, very little room for error. There is just 16 billion pounds worth of fiscal headroom against the fiscal rules, meaning that if we get even a relatively minor macroeconomic shock, or if the OBR's forecasts, which, to be honest, already look a little bit optimistic, don't come to pass, then Rachel Reeves is back in the Commons, either trying to raise more revenue through tax hikes or trying to beg the markets for more borrowing. So it's unsurprising that gilts have suffered, should we be kind and say, a bout of indigestion on the back of the budget, with 10-year yields rising around 25 basis points since Rachel Reeves stood up in the Commons, trading north of 4.5% last week. Of course, this leaves the Bank of England in a bit of a difficult spot, because you've got a budget which just as there were signs that inflation was starting to ebb and that we were stamping out persistent price pressures from within the economy, we've actually got quite an inflationary budget. Now, I think the MPC is still set for a 25 basis point cut this week. They meet Thursday lunchtime, as Ryan alluded to, and I think the electoral uncertainty from the United States will see them take the path of least resistance as well in what is likely to be an 8-1 vote, with just Catherine Mann dissenting in favour of keeping rates steady. But I think beyond that, the chances are now that the pace of future rate cuts is likely to be considerably slower. It's probably still going to be a case where the BOE are cutting by 25 basis points per quarter, at least until the first quarter of next year, with Bank of England Governor Bailey, who said last month or even a few weeks ago that they could be more activist in cutting rates. Well, it seems, if anything, they might have to be activist in stabilising the gilt market if this carries on.
Oh, no, I have to take a really deep breath and try and make sure I don't turn down Rant Avenue for this response. Yeah, the super nuts of it, a lot of high taxes for very little growth. And that's been the main reason why the market's done what it's done, particularly in gilts, raise yields, because it says, well, you're doing all this effort and it's for little reward. Now, you could say 1.5% growth, you'd bite their hand off given what growth's likely to be this year. So, one could say it's going to be a bit of an improvement, but still it is a lot of extra borrowing, a lot of tax hiking for very little reward. And I think that's going to impact the market, moving forward. For the Bank of England, yeah, there's a case to say it could be inflation. We've already had stories out this morning from some of the big retailers, supermarkets who are going to be facing some big bills now on those higher national insurance taxes, obviously meaning they're either going to cut wages, cut employment, or they're going to raise prices. And we know what the path of least resistance is to raise prices. So there's your inflation argument. But it puts the Bank of England in a difficult situation where, again, they're looking at the inflationary side. But if it's going to lead to higher unemployment, that's something that they're going to have to also deal with by cutting rates. So there's a bit of a rock and a hard place for the Bank of England, as usual. They're always there. As for the OBR, you know my thoughts. You know my thoughts on them by now. The Office of Bodged Responsibility. The day they get a forecast right, you probably see me sprout a ponytail. So that's all I'm going to say on that matter as to whether those forecasts are right. And I don't think they've ever been right in the whole history of them ever producing them.
I would pay to see that. If anyone's got one of those sort of Davy Crockett hat type things, then do send one in to the Pepperstone offices. I'll make sure it gets its way to Ryan. In any case, let's move on because I think we're ending where we begun with the US election again.
Yeah, I'm going to talk about trade and how it's best to get through this event. We've spoken about the magnitude of this week and how it might be a wild one for traders. While that volatility does look inviting for making lots of pips, you have to remember that same volatility can lose you lots of pips too. So I think there's two ways of trading through this week. One way is to follow the headlines over the election and trade the reactions, but you need to be quick to interpret those headlines and be right about them. The safer way to trade is to fall back on the fundamentals. Elections can change landscapes very quickly, but the fundamentals can move much slower. We know where the US economy is at. We know where the Fed is at. We know what they're likely to do next. The same goes for other countries and their currencies and various assets. So while there may be fallout from the US election, it will take time or a while for it to be borne out in the data. So you don't want to get caught up in the volatility. If you don't want to get caught up in the volatility, match the election moves against the fundamentals. Look for opportunities there if prices are pushed out of sync with the fundamentals. And as always, as we said earlier, account protection should be your number one priority this week, and especially when we have all these big risk events. So think about maybe cutting your trade sizes and being a bit tighter with your stops. And finally, remember the old trading saying, if in doubt, stay out. Markets will still be there to trade when the dust settles. So if you're not sure, you don't have to trade.
Yes, absolutely. And I'm glad you brought that up because I was going through various sort of scenarios and potential election outcomes. And I just saw a tweet from our very good friend Ryan Paisley pop up on my screen while we're talking, and I fully agree with him for once. You and I could know the election outcome now. We could be locked in a little darkened room somewhere, have our phones taken off us, and be told what the election outcome is. I bet you we still wouldn't be able to predict every single market move that we would see on the back of that. There are a hell of a lot of moving parts this week, and I think very much the focus should be on ensuring that you're around, so to speak, to fight another day. The markets are not going away just because the election is done and dusted, as opposed to having the urge to jump on any election move that we might see on Tuesday night and into Wednesday morning.
Yeah, and particularly for US traders, it's these elections are a very emotive subject, and it brings you back to another saying that you need to trade with your head, not with your heart. You can't let your own politics, your own feelings of what's happening influence your trading, because that usually leads to making mistakes and losses. So try it and be objective when you're actually trading this.
Absolutely. Right, let's move on to some charts. Right, so I want to have a look at the equity complex first of all. We've got a whole host of things to get through this week. We did see some further downside last week. The S&P notching its first back-to-back weekly declines since August. I think this was a combination of continued de-risking into the election, and we also had some poor-ish results from Meta and from Microsoft last Wednesday, particularly in terms of guidance, which cast a little bit of a cloud over sentiment as well. Do you see what I did there? The near-term
I thought I was going to get through one show without a dodgy pun, but
no, never.
Nope.
Now, of course, the biggest near-term consideration for the market is, of course, the election. And as we said earlier, I think on the night, at least, the biggest issue is when we know the result rather than necessarily who wins. One thing that is worth bearing in mind, actually, on election night is the potential for gapping risk. Obviously, there is an hour where the S&P future is closed. Just because the S&P future is closed, it doesn't mean they're going to stop counting votes and stop calling state results. So the market could reopen in a very different place to where it closed. So do just bear that in mind. Now, I think, as I said earlier, the more protracted a process we see to get a winner, the more potential downside we see in the equity market, at least in the short term. Because I think in the longer run, you take a step back, as Ryan alluded to earlier on, you take some of the emotion and some of the politics out of it. The bull case remains intact. I mean, earnings growth is still very strong, north of 5% on a year-on-year basis. The GDP figures that we had out of the States last week, 2.8%. The eighth quarter in the last 9, north of 2%. Economic growth is still clearly very strong. And the Fed put is still there to backstop sentiment as well. So I think once the political uncertainty fades away, dips will continue to be viewed as buying opportunities.
Yeah, I have to agree with that. And the S&P is maybe a good asset to watch post-election. Like you say, let the volatility play out. Mark your levels, go on a higher time frame, like a 4-hour daily, even a weekly chart. Pick your bigger, stronger levels to look at. If you get a move down to that 5,200 level, that's a big one. Even down to the 5,000 level, okay, there's a bit of a way away. If we're going down there, something's probably changed. But still, you've got to wonder whether this short-term event is going to break decades-long rally in stocks. And if it's not, then it just becomes a minor dip to buy, even if it is a 500, 600, 700 pip move. So go on the wider time frames if you want to get yourself out of the noise and just see what it wants to do, and as I say, just judge it as it goes on the election.
Yeah, I certainly hope we don't get near that 5,000 mark. I've got a lunch bet riding on that. Will Thompson, if you're watching, remember that.
Another lunch bet. How many have you lost to him?
Well, none actually. I'm hoping I can win this one. I know that's a rarity with my betting at the moment, but fingers crossed. Anyway, let's move on before we get in trouble for gambling.
Well, I want to know what's the other side of that bet first before we move on.
Well, it's a time limit. I think the middle of next year is the time expiry on it.
Okay, all right. So when you get your lunch next time, then good to hear it.
Exactly.
Right, yeah, I'm going to look at a potentially non-US election asset to trade over this one. Euro sterling. I was looking at this pair last week for a potential break trade either side of the 83, 84 range over the UK budget. But I thought I'd come back to this one as it is a pair that you can look to trade if you want to keep out of the bulk of the election noise. So last week I was looking at this pair over the UK budget, and while it was fairly quiet initially, the verdict since then has seen UK yields rallying and the pound weakening. We did in fact get a break out above that 84.20 zone, but it didn't confirm and it didn't last long, and we came back below pretty quickly. From here, I think we're in dip buy mode after the budget, so I suspect the low 8300 level will remain solid as support. A secondary break and hold above 84.20 this time might be the one that gives it the fuel to push it higher up towards the bigger zone at 84.80, 8500. Now, this pair won't be completely immune to the election because usually big moves in the dollar tend to go at different speeds between cable, pound versus dollar, and euro dollar. What happens is cable tends to move more than the euro, which can then obviously move this pair. So if this pair does move, one will need to identify whether it's moving on the fundamentals or whether it's a dollar move, as that does make a big difference. So I'm more inclined to go with a fundamental move in this case and fade a move that's brought about because of the dollar if it's excessive. So it is one to keep an eye on during election, but if you just want to take a step out of those assets that are directly linked to the election, then this might be a good pair to look at.
Yes, I think you make a very, very good point there. If you do want to take some of the noise out of the equation, I'm not going to discuss that too much though, because I want to talk about the pound in my play of the day actually, and I think most people will probably know what my view on sterling is likely to be at this point. In any case, let's have a quick look at gold first of all. We stalled out a little bit last week, just shy of $2,800 an ounce, although we did print 3 or 4 record highs in the process nonetheless. I think it's still too early to say whether this is a definitive near-term top in the yellow metal or whether this is merely a pause in the recent rally. And certainly just looking at this chart as to how we've traded this year and chiefly in the second half of the year, recent performance would certainly point towards it being the latter. And it's interesting actually to note that the yellow metal is up about 36% year to date. That is the best year-to-date performance for gold in at least the last 30 years. So clearly the yellow metal continuing to believe in its soul and shining brightly. I do think that if we see a slide back... I do think that if we see a slide back under 2685, which was this kind of resistance zone and in early to late September, that could perhaps give the bears a little bit further momentum and would be taken, I think, as a sign that we have put in a little bit more of a convincing top. But this is certainly not something I'd be looking to fade just yet, more something I would be just keeping on the radar, particularly with political uncertainty here and geopolitical tensions still simmering away in the Middle East. I would be looking for a few firmer signs of a top being in before looking to fade any strength. But I thought interesting nonetheless.
Yeah, I'm going to put in a complaint to Westy now. Enough's enough, mate. It's gone too far, these puns. I'm going to have to make some remonstrations to the boss man. But aside from that, yeah, gold, it's a bit similar to the S&P. If you understand the reasons why it's been rising, then you know that this election is just going to be short-term noise to it. You know, we know there's a lot of central bank buying going on at the moment in gold. Whether China have stepped back to the plate, we don't know. But there's plenty of other central banks who have been hoovering it up. As you mentioned, the risk events going on are going to keep a bid in this. So yet again, this is an asset where if you get an adverse reaction going against the trend, which is a far longer trend than the elections brought anyway, then again, it potentially becomes a dip buying opportunity. Again, pick your levels, know where you want to trade. That 2685 level is a big level. It was the break point. And you've got levels well below that. So keep an eye on this one. Again, I'm on your side. I favour dip buying. I'm still long a little bit from 26.30s, so I've got a bit of skin in the game in this one. And I'll be looking to add back if the conditions are right.
There we go. Last, but by no means least, copper. And I'm assuming you know the one word or nickname you can't use it.
Yes, of course. I wouldn't dream of lowering the tone on this show any further. That it's been lowered already by
Enough as it is, isn't it?
Exactly. Anyway, so copper's, it's been walking a tight line, and it continues to look interesting as it's holding, a pretty solid line around the 50% retracement of the August rally. And we've been talking about the global weakness in manufacturing and more broadly in China, but small signs of things picking up and will be an added bonus for this commodity. We've seen some of that today with some of the manufacturing PMI numbers picking up, particularly in China as well last week. Demand has remained pretty strong too, and that's helped the price remain steady, particularly during October. So for me, it's pretty clear to see the trade here, which is long off the 430 level, or on a confirmed break above the 443 level. There's maybe even some merit in a small tight long if we start holding above that old 38.2 fib at 439. If we get confirmation there, then maybe one can try a small long off of that and see if we move on up. But everything will be invalidated if we get a solid move below 430, which potentially means something has changed, and that will get the alarm bells ringing. So I'm favouring the long side for this one at the moment.
Yeah, again, another one with plenty of moving parts. I guess China is going to be a big part of the story here as well. And one thing we haven't touched on is we do have quite a busy slate of Chinese economic data this week as well. We get the monthly trade figures on Thursday morning, I believe, here in the UK, which is likely to play a role as well. But definitely another one to keep on the radar, as if there wasn't already enough to have on that proverbial radar this week.
Yeah, I need a few more eyeballs to keep on the screens that I've got at the moment.
Well, you need to be awake, first of all, mate. That's the other thing.
Right. Sleep with one eye open. There you go. There's a heavy metal song for you.
Oh, dear. Right, let's get on to our plays of the day. Okay, so I want to look at cable this week. As we were talking about earlier on, the market taking a relatively dim view of the budget. And I think perhaps the most worrying thing is that we've actually seen sterling weaken quite significantly, even as gilts have sold off and yields have risen fairly substantially across the curve. And that is, to put it politely, never a particularly good sign. Cable subsequently trading considerably below the 130 handle and also back below the 100-day moving average. And I think the market is really and rightly taking a bit of a dim view of the UK's anemic economic growth prospects and what is likely to be ballooning levels of government borrowing. That is a pretty toxic mix when we have the gilt market on edge anyway. And I think as a result, we are likely to see further downside in the pound. Now, there's a couple of things to bear in mind here. I think in terms of downside and where support may come in, the 128 region is the obvious target, given that is where both the big figure lies, but also the 200-day moving average. But I think also it's worth considering if we were to see any dollar weakness after the election, then perhaps this would be a move here in cable that is worth fading, given that if you look at, for example, the euro, you may see a relief rally if there's not going to be tariffs on the eurozone. The same with the Mexican peso, for example. The pound, where's the organic, idiosyncratic reason to be long of sterling? Frankly, I don't see one at the moment. So selling at spot and perhaps if we were to move higher in cable, fading any rallies as well. Ryan, you are looking into the fixed income space, I believe.
Yeah, I'm looking at 2-year Treasuries as probably my preferred election asset to trade, because I think it's the closest or the cleanest trade to look at over the election is going to be US bonds in general. So I'm going to be looking at these twos, and I've been watching these for a few weeks now as I feel there's a fade to be had on higher yields because we're really pushing against where the Fed are expected to take rates to. Yields have rallied on the election and this Trump trade that everyone's been talking about, which means if he wins, we might see a further rally, which will mean obviously a drop in the actual price of bonds. I'm looking to buy down into the 101, 100 area. That would likely mean yields approaching the 2023 highs around 5%. The reason I'm going for 2 years is that even if Trump wins, it won't stop the Fed from cutting in the short term. And as mentioned earlier, it will take some time before Trump's policy starts affecting the data, if it does at all. So a rally in yields further along the curve may not be impacted by the Fed as much as these short-term yields. Even if you're not trading bonds, you need to watch yields over and after the election, as you know, this is definitely one of those times where bonds are going to lead everything else. And again, it just falls back on what I was saying earlier, that you're looking for markets to maybe push an asset price out of sync with the fundamentals and what the central bank are doing. So that's my play. If we get a decent dip in bonds, I'm going to be a buyer.
Absolutely. Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forexpo Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, as well, for bringing things together, as well as always. All three of us will be back with another episode of The Trade-Off this time next week. Actually, Kyriakos won't. He's on holiday. Someone else will be. Nevertheless, Ryan and I will be here because we're not work shy. And we'll have plenty to discuss next week, including the aftermath of the election and those 5 G10 policy decisions as well. As always, hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and how you're viewing things into and, of course, after the election as well. And we will see you in a week's time. Thanks very much, as always, for watching, and goodbye for now.